Good morning, ladies and gentlemen. Well, very important week coming up. Well, we have auctions Monday and Tuesday, followed by CPI on Tuesday as well, and then finally the FOMC, and not to be outdone, even the ECB on Thursday. So we'll get lots of data, and it's important to analyze the most important part, which is going to be what the Fed dot plots will be, because that will set the tone for the whole of the yield curve and therefore all asset relationships. As far as the model is concerned, as you can see, the score keeps on rising. There is absolutely no reason that the model sees why equities would not continue higher. And really the path that we are on, if you look at this chart, is the usual path of a bull market. And this basically says that we have another, almost 6 to 9 months to go until we reach the typical peak in price and in time during a bull market. Does this mean very much? No, not really. But while it stays within these lines, it's just telling you that the market is doing nothing atypical, and that is certainly important. Just one slightly interesting side note: if you go to spread ratios aggregate, you will actually see that the volatility stack for technology has begun to rise, as opposed to the volatility stack for everything, which is slowly coming down. It is not significant as yet. It's just telling you that there is a lot of rotation going on, and at the moment the rotation is out of technology into other things, and it's not very strong, but it's just telling you that people are seeing the potential for more volatility in long-term interest rates. And therefore, when they see that, they tend to do a lot of rotation in and out of the technology sector. And since the technology sector is such a large component within the overall indices that we trade, like the SPX and the NASDAQ, it is it tends to make them go sideways for a bit while this is resolved. I think it will probably be resolved by the dot plots, and without further ado, let's talk about what those will show. So here we have the last summary of economic projections that the Fed published in late September. And what is going to be interesting is the changes they make to the 2024 outlook. Of course, the 2025 will be important too, but nowhere near as important as the 2025. So last time they had real GDP at 1.5. Could it be that they bring it down slightly to, let's say, 1.3, 1.4? Absolutely possible. They had the unemployment rate at 4.1. We had the unemployment rate at 3.7 on Friday, and it's very unlikely that they take that up. It's more likely that they bring it down to, say, 4%. And then we have the inflation, especially the core, which is the important one. I think it's unlikely that they bring it down, and if they do bring it down, it's going to be something like 2.5%. It's not going to be, very different from this last figure they had in September. So using their own modified Taylor rule, that would mean that the dot plots, which are here, would get mechanically reduced because we never got to the 565 level. We stayed at a 535. So this naturally falls out of the equation. And using their own modified Taylor rule, using those inputs we just talked about, I really can't see how their dot plots are going to be any lower than 465. So anywhere between 450 and 475 would be the mechanical modified Taylor rule that they say they use. So we have to take them at their word, and that is the only dot plot that we can possibly think is realistic using their inputs. Now, if they want to make a statement, they will be up here. So all these will get squashed, right? I mean, that's obvious. And the only question is going to be how many are going to be here and how many are going to be there. So it has to be below 5% because otherwise none of the inputs make sense. If the inputs are, what they will be, unless they go for inflation, core PC way lower than I've just told you, which I really don't see why they would, but it would be a statement, wouldn't it? Then this is where the dot plots should be. And that is important because these get squashed. These for 2025 will naturally get squashed, but they're much, much less important than the ones for 2024. And if I think that it's going to be anywhere between 465 and 475 for the dot plots, I really can't be all that bullish for the short end of the curve. And that will be a statement from the Fed. They will be telling you, do not get ahead of yourselves, boys. So if the dot plots are the ones we just discussed, around the 465 to 475 area, what is going to be the reaction of the yield curve? Well, the twos, they have to go and trade up here. They have to trade between 480 and 485 as immediate reaction, something like that. And then we are back to being in the 475 to 490 trading range. And that should just send us to sleep for the rest of the year. The yield curve, well, what can it do? It can just continue to flatten slightly until we start getting some important new data. So fives back up to, 436, something like that. And the least amount of pain is going to be suffered by the 30 years, which will probably go back to 439. So we're talking about, 8, 9 basis points in the 30 years. And we are talking about something like, 10, 12 basis points in the twos. So a modest flattening. I can't see anything but that if those are the dot plots. The only fly in the ointment could be a very low CPI. CPI should be good, and I think the market knows that CPI is going to be good because oil prices have continued to go down. So I don't think there is much danger coming from the CPI number, but I do think that the Fed, if it wants to make a statement, it's going to keep those dot plots around very close to 475, telling the market, okay, we understand, what Waller has been saying, i.e. that real rates must be kept at a restrictive level of, say, 2%. And if that is the case, there is really nowhere for the 2-year to go but slightly higher. Why would you be paying negative carry more and more and more when you know that the Fed funds rate is going to be held for most of next year at the current level? So in light of those comments, let's have a look at the yield curve. This is now 2s, 10s. Well, the natural tendency should be to go up here towards 57, 58. If we then look at 5s, 30s, the natural tendency should be to go to 0. And if we look at something like 10s, 30s, I would have thought that if we see these levels, -5, i.e. 5 positive, I think that is a good opportunity to start putting on steepness. I think that is going to be the last opportunity we get before next year to put on steepness. And even something like 2s, 3s, that is the only one I don't see steepening. That's the one I see flattening continuously. Why? Because people will be starting to push out their money into the belly, 3s, 5s. Why hold it in 2s if the Fed's message is the one that I just mentioned? It doesn't make any sense. You've got to push money out. So even if you want to be invested in 2s, you better be invested in 2s in a year's time. And those are 3s, 4s, 5s. That is what you want. So this part of the yield curve, the very short part of the yield curve, can be stable to go higher in yield, while anything from 3s, 4s, 5s outwards should really start anticipating that at some stage next year, the Fed starts easing and you start getting towards a positive yield curve. Now, the one central bank which probably can afford to be as dovish as it likes is the ECB. I doubt they will be, because just like the Fed, they want to make absolutely sure that there is no second wave of inflation, and therefore they're likely to, pass the buck and be slightly more hawkish than they should be. But I don't think it's going to have much effect. I think the market knows that Europe needs lower rates, and I think the market knows that the ECB is basically not a very serious institution, and they can say, something one day and change their mind by the afternoon. So I think any pullback in the shats and the bobble is going to get bought. What would be some good levels? Well, naturally, this level would be ideal, but I doubt very much it gets there. I can't see much in the shats going above this kind of level, 280, 282. Naturally, the tendency, if they are slightly more hawkish than the market is, will be to flatten the curve there as well. And I think the bobble is your absolute ideal instrument here. Now, we got exactly to 212, got out, thank you very much. I would be very surprised if we see 245 again. I think it's much more likely that it's going to be a level like this, 234. And that is where you probably can afford to start putting on long bobble positions. If we look at the 10s, it's going to be something like this, somewhere around the 235 mark. So I think the curve there should continue. Look at the 2s, 5s. It should flatten a bit to this kind of level, 51, something like that, 4-5 basis points. Nothing huge, but it should be a flattening tendency, because I don't think any of these central banks have any interest in letting the market have as much free rein as it would like to have. We all know how markets are. You tell them that you're going to ease, they're going to take 3 easings, even though you meant 1. So it makes sense that the central banks need to be more hawkish than the market. The market adjusts slightly for 3, 4, 5 days, and then it goes again, because that's the way the markets behave. The first bit of additional bad data you get in the Eurozone, the market will go straight to new highs in terms of price on these bonds. Just the way it is. They'll forget all about what the ECB or the FOMC or some dot plot or whatever, and they will go for it. just the way markets work. Now, the one that's interesting, of course, is Germany against Japan. This is twos, and you can see what happened last week and the corresponding effect you had in the euro yen. What do I think happens? I think any retracement is going to be very modest, because let's have a look actually at twos Japan. I mean, that's the one that went up last week, but I don't think it continues to go up. I think it stabilizes now around the positive area. I can't see it going down much more than 5-6, around the 5-6 basis points mark. And it'll stabilize there until Wader decides to start hiking rates, or abandoning ZERP rather. So you have a continuation of a logical trade. And if we look at fives, this is it. And if you look at tens, this is it also. But look at where these came from, okay? Look how much further eventually these will go. These could easily go down to here, right? And that's another 90 basis points lower. If we look at twos, can it go down to here, 130? Yeah, that's 130 basis points. So you can see that there is one hell of a lot that the Japanese could tighten and Europe could ease. And for next year, I think that these are probably the trades that are going to make the most money. And that has the implications of what the Euro-Japanese yen is going to do. And that's all there is to it. I think Japan stays firm. They keep rates firm in positive territory, and the big easing happens in Europe and eventually afterwards in the States. It's notable how the Dixie actually did absolutely nothing last week. So range trade, 0.5%, 0.75%, whatever, I think it's still stuck. The important one is what it's doing in the cross, and this is the Euro-Japanese yen. As you can see, it's come up against the 200-day moving average and bounced. It's quite normal that it should do this, and it makes sense that it should bounce around now around this area here, 158, and basically bounce off it like it did here and do some kind of head and shoulders before it goes down. What does that imply? That implies that interest rate differentials don't move a hell of a lot over the next few weeks, over the holidays, and only move at some stage in, I don't know, February, March of next year, which would make sense because, as I told you, I think the ECB has really no upside in being extremely dovish at the moment. Why not hold rates for a bit longer? It's not going to make that much more difference. And the Fed is going to do the same. So you should be getting a period of stability in everything. And when you get a period of stability in everything, you get, retracements and lower volatility. I think everybody who needed to get out of the yen was stopped at some stage last week, and now it keeps on bouncing around, between this 155 and 158 area for a bit. Let's hope so. And then you get a good entry point for what should be the next big wave back down towards these levels around the 147 area. And that would make sense if you compared it to the differential chart of the interest rates. At some stage, it's going to go a lot lower, and at some stage, Euro-Japanese yen is going to break a lot lower too. Gold didn't like last week, and that is perfectly normal. Now, what have I told you so far? That I think the Fed is going to tell the market that it likes 2% real rates and that it wants to keep rates real at 2% for quite some time. Now, gold should absolutely hate that. A 0% asset trying to compete with a firm 2% should, basically wilt because it just can't compete. And in that case, I really see no reason why over the next few weeks, gold should not be trading in this same kind of range down towards 1958. And, I just don't see what the attraction is in gold. Why would you buy it? The only reason that I can think of is that some central bank that is afraid of getting its assets confiscated by the US Treasury buys gold instead. But that can last only so long. Unless there are absolutely huge moves in FX which would justify it, I really can't see gold doing very much at all here, but going sideways. And it keeps on going towards this 200-week moving average above and below, and basically, trades there every other week. And that's 1977. And why not? What is the big attraction in gold? I just don't understand. So let's have a look at gold over tip. So an asset yielding you 0 compared to an asset which the Fed, if I'm correct, tells you will yield you 2% for a very long time. Now I got out here and swapped all my gold for tip. What is the logical thing to do? This is an adjusted chart, so it gives you the dividends for tip on top. Well, what it should do is at worst stay stable, at worst stay here, and then you get your 2%. But I think it's much more likely to come down and trade around these levels, around the 150 over time. And when will it start rising again? Well, only, I think, when real interest rates start coming down, and I really can't see that happening before the, quarter 2, quarter 3 of next year. I certainly think during the first quarter, they're going to remain, the Fed is rather going to try and hold them around the 2%. Naturally, it's completely data dependent. But that is what I think they will try to do to make absolutely certain that there is no second wave in inflation. And that makes sense to me. And therefore, I think that gold is going to lose its luster to tips over the course of the next 2 or 3 months. And then probably it can start rising again once the real interest rate hold that the Fed has is slightly relinquished. Oil got to my buy area, 69 and below, and it's bouncing. And I think, if you look at the way this market's structured, it's not going to go any much higher than 73, 74, something like that. It bounced off the 200-week moving average and closed at the bottom of the weekly Bollinger Bands. That to me indicates a market which is at best going sideways. We've been down like 7-8 weeks on the trot. A small move back up towards 75 or maybe 76 and whatever is not out of the question. But it's not a market that's going to frighten the bonds, because the difference between 70 and 75 for a few days, it's really not going to make that much difference to the bond market. I don't think the bond market is going to look at oil until it starts going above 80. So it's a market which frightens no one at the moment. And much like DBC, which also can't frighten anyone, look, we started the year around here, around this 24 odd level, and we are, well, with 2-3 weeks away, we are lower. We are 4% lower, let's call it. So commodities have done nothing all year, and that is why inflation is not higher than it is. And that is probably why the Fed is going to say what it's going to say in the dot plots and try to hold things exactly where they are. I mean, this DBC chart has certainly helped them to do that. And I think it'll go sideways to down now until it reaches this 200 period moving average, and then it's going to start bouncing. So we have certainly probably another quarter of sideways action in oil and commodities, and that is the reason why I don't think bonds are going to make new highs in terms of yield, but I do think that they're going to go up next week in terms of yield, because everything will be against them. The Fed will be against them. The ECB will be probably against them. And you should get a small bounce in DBC and a small bounce in oil, which will also pressure them. So, but I think that is going to be very marginal, and that once bonds reach those levels I discussed earlier, the market will certainly buy them. In equities, the only market I find interesting is the spread between Japan and Germany, or Europe in general. So this is EWJ over EWG, and that I think is going to here 206. It's now 216, so that's another 5%. The pressure is all on Japan because of what Wada said, or intended to do, or will do, and really that is all there is to it. In constant dollars, which is what this shows, EWJ is going down against EWG, which means you sell the Nikkei and you buy Germany. No doubt whatsoever to me. And that triangulates with everything I've told you about euro yen and the interest rate differentials and so on. To me, there's another 5% in this easy. I wanted also to show you the longest chart I can get of the stocks. And this is a monthly chart, of course. And you can see that basically this 45.80 area is the highest it got since 2007. And we are basically knocking on the door. This would be almost a 20-year breakout if we start closing above. And that to me says that Europe is not going to go into recession, but that's because the ECB is going to ease a lot at some stage, and that is going to help European stocks. Just be aware that that is what the monthly chart says. It's opened up these Bollinger Bands. It'll go to the monthlies, so I think you are likely to see a big move in Europe, probably starting next year, but breaking out of a 20-year just about consolidation range, buy some options. Let's have a look at my clean chart of the SPX and enlarge it. I mean, last week I told you that this 45.42 level was very important, and not for a single moment did we close below it. And on Friday we closed above. I think it's pretty clear that the market wants to go to 45.46 and that possibly to 47.12. We are still not overbought on this spread relationship, which I think is very important, we still have quite a bit of room. So what is likely to happen, and how do I triangulate it with my view of the bonds? Well, if the yield curve does flatten on the release of the dot plots, which to me are the most important thing that comes out next week, what will that mean for the longer end of bonds? Well, probably not a lot. 5, 6, 7, 8 basis points is not something that the stock market is really going to be too worried about. And if the stock market is not too worried about, the dip that comes on the bad news in inverted commas of the dot plots is going to get bought. So I really can't see too much downside in stocks. I mean, could I be surprised by the dot plots? Yes, and I'll change my mind. But until I've seen the dot plots, and they are significantly more bearish than the ones that I've explained to you, and the reaction function of the market is different from the one that I've predicted, why would I get bearish of stocks? I just can't see it. I don't think there's any point in going through more stock charts, because simply I am either going to be correct in my interpretation of what the dot plots are going to say, or I'm going to be wrong. So until we've seen the dot plots, really no point in preparing ourselves for big moves one way or another. I'll tweet to you as soon as I see the dot plots and I've read the summary of economic projections, what I think is going to happen. I've included a link here to the last one so you can read it for yourselves, and that was the first thing that I showed you. I think next week is going to be as simple as that. We get out of the way of CPI, because CPI is going to be good and we all know it's going to be good. So I think the improvement in the market as a result of CPI is going to be very modest. And then we wait for the Fed and the dot plots, and we will know exactly what to do after we've seen them. Thank you very much indeed, and have a lovely weekend. Tweet you tomorrow.